evening and welcome to D Street. This week it's been a very good day as far as the markets are concerned. A good start to this trading week. The fact that Sensex is at a 25-month high and the Nifty has hit a new 52-week high. It seems like the going has been quite great. And of course, economic data across the world are what's actually leading the advances. Good evening, Savina.
Across the board, banking, mid-cap banking was one strong area. Marico, they're controlling another 5%.
Well, it's been a pretty good day of trade for D Street. We'll take you through the market, of course, so what drove the stocks higher, and of course, the sustainability of this rally that we've seen. We'll get you some perspective as well on D Street today. Jagannathan, equity head of SMC Capitals Limited, who will join us to talk about the outlook for the markets going ahead. Welcome back. You're watching D Street. Let's go across to a very special guest joining us. Jagannathan, equity head of SMC Capitals Limited, joins us from Delhi to talk about the outlook for the markets. Thanks, Jagannathan, for joining us this evening on NDTV Profit. Jagannathan, just to get started, 1.5% higher, the Nifty closing in at its day's high pretty much, 53.68. I believe 53.88 is the new level that the markets will now be aiming for. Are you expecting that, or rather, do you see there's enough momentum in the markets to take it higher up from here on?
Yeah, technically seeing the market is showing strength for sure, and the momentum may take the market slightly higher as well. But fundamentally, if you see, even if we assume a 900 rupees EPS for Sensex, the market being at 18,000, it is comfortably at a 20 times PE multiple. By no stretch of imagination, the market is in undervaluation zone. So the euphoria may continue a little long, but it is too risky to play for the last leg of the euphoria. So every high, every rally, I think investors will be better off taking as much profits as possible because markets are showing almost all the signs of typical bull market euphoria with small-sized IPOs and heavy oversubscriptions and good listings, and so almost all kind of euphoria. Point is well taken that GDP numbers and Indian performance as well as Indian corporate performance has been good and will continue to be good, but the point is at what valuations is the question. Having an apple every day is good, but you should buy the apple at 10 rupees, not at the 1,000 rupees.
Yeah, but Jagannathan, there has been a lot of talk about the last 8 to 10 weeks. I mean, everybody out there insisted that a correction could be something that is expected and could be around the corner. But realistically, that's not really happened. Yes, there were concerns in Greece, Spain, we all talked about it. But I mean, the money keeps coming in and the markets continue to gain, not just locally, but globally as well. It's pretty much a similar picture, right?
The market is absolutely underpricing the risks involved. That is slightly concerning because be it international factors or be it local factors, it is absolutely not taking into account. And after a 100% rally, without a significant correction is quite surprising because market has rallied almost from 8,000 levels to 18,000 levels, so that is more than 100%. So it is that means we are almost defying the gravity now. I think we are getting into a zone where it will be better off for the rational investors. It will be better off for taking some profits definitely from the table.
Good afternoon. This is Ashu joining from the Delhi studio. Okay, let me play the bear here right now. I just want to know that if we are overvalued and if you think that we are slightly stretched, so what should an investor sell? Would it be the usual high beta sectors, auto, metal, real estate? We all know valuations are stretched in the metal space, auto also commanding relatively higher valuations. So perhaps acting as a bear with a long-term view, is it best time to start selling these stocks?
Yeah, I mean, definitely, for example, after 300-400% rallies in the areas that you said, be it automobile and real estate, so definitely it will be better to take off some of the profits because it's natural. Whenever there is a rally, it's natural for the market participants to get thrilled and it's naturally to run along with it. But it's all about rationality and how long will you be running along with it is the question. So definitely taking out some of the beta stocks will be better off because from now on, at best, you will get only the very modest return of 10-15%. It's a consolidation of almost 8-9 months. So now we are trading higher. So definitely, technically seeing the market may rally a little bit, but it is better to sacrifice this rally instead of getting caught at the very wrong end of the market.
So even if let's assume that we start selling at these levels, would it be best to keep on investing in the small cap space? Are those valuations looking a lot better as compared to the large caps, or do you think small caps also have pretty much caught up with the way frontliners moved, and even though fund action is quite prevalent in these stocks, but still it's not the best time to get into them?
Yeah, in fact, if somebody wants to play a little conservative, it's better to be the front lines, because small caps, the element of volatility and the element of risk is a lot higher, because of the fundamental reasons, and the size and the scalability of these business models are slightly concerning. For example, last financial year, that is April 2009 to March 2010, the small cap index has rallied more than the large cap index. And one more thing here is, for example, if you see September 30th, 2007, that is 2.5 years back, the market is at the same range of 17,500. That means after 30 months, we are at point to point, our return is absolutely nil. So that means we have moved all over the place, be it high, low, etc. But on a stretch of 2.5 years, we are absolutely in a nil return zone. So people have to be slightly careful, and Indian growth story is great, but not at these valuations.
Hi, Jagannatham. One counter that I want to pick up on is Reliance Industries. One of the biggest reasons that the markets actually went up. For a long time, we've been complaining that RIL hasn't been participating in the rally, but 3% higher today. What is the sense that you're picking up on this counter? Would you buy into it? Are you bullish? Crude price is also looking pretty firm.
I think after a long time, Reliance has shown some bullish sign today. So because it has been in a range for quite some time. So the players who want to continue the momentum, they may continue a little more time. So because whenever the Reliance starts the rally, generally it can go much higher levels. But whoever is sitting on decent profits can take out at least 50% of the positions.
Jagannatham, what about the ADHE pack? Most of those counters did exceptionally well in trade today. I'm not too sure whether you track that space, but is it just a momentum-driven kind of gain that you're seeing, or there could be some real value out there as well?
I think when the momentum is going on, almost everything will go up. When the tide goes up, all the ships appear going up. So the same applies here. So unless investors have done their homework and understand clearly the kind of sectors and the investments they are doing, so it is slightly, they have to be careful in these spaces.
Jagan, let's be stock specific here. Talk about Bharti Airtel. The deal has been consummated, and if you were to look at the valuations post the deal, it sums up that EV by EBITDA for FY11 is again slightly higher than what the kind of valuations some of the global peers are commanding at, and of course the fact that the company's the deal is likely to be EPS dilutive for the stock, but still we have seen some major gains. As a matter of fact, Bharti was up nearly 5% today. Do you think that perhaps the worst is over? Again, the concerns that are there pretty much are around the debt aspect of it. Again, once more clarity emerges on the 3G front and mobile number portability, that's when we could see some real action picking up on frontliners like Bharti.
Before this transaction concluded, Bharti is the best quality balance sheet that India has because the lot of cash, almost negligible leverage level. So the Bharti was in a fantastic shape from the balance sheet point of view. After this transaction, even the Bharti transaction will get into the leverage zone, because $8.5 billion of loan, even for a Bharti's capacity, is quite some loan. And that too, they have almost paid 10 times EV EBITDA for Jain. That is by no means it's a undervaluation, and already telecom industry is going through a period of phase of pressure. So 3-4 quarters of EPS dilution is almost guaranteed. But in a large transaction with a 100% controlling premium, and you have to pay that kind of valuations. In a 2 to 3 year frame, I think Bharti, this transaction may prove to be a big success story for Bharti. But in the short term, the pressure will continue. I think telecom can be a good buying bet maybe in the next 8 to 10 months, when a sense of more nervousness and more fear creeps into this industry and more consolidation is on cards. Then probably Bharti can prove to be a multi-bagger at that point.
Jagan, talk about the auto space. I know we were discussing this earlier, that again valuations is something you are a little concerned on, but going forward, the kind of growth we have seen on a month-on-month basis and the kind of guidance most of these companies, even I just want to reflect on Hero Honda, Bajaj Auto giving stellar guidance there. Do you think that input cost pressures, even if we do tend to see them, would not be able to match up to the kind of growth these companies are likely to see? Demand growth is there, even margin improvement is being talked about. even though margins could remain at about 20-22% for these companies. So do you think both these aspects have that kind of capability to take these stocks to much higher levels?
Demand growth and volume growth will be there, Ashu, no question about that. And nobody is denying on the front of India's potential and the volume potential. But having said that, only point is all these things have been already factored into the prices. That's the whole point. So every new positive development, we cannot expect that share should rally after every positive development, because we have 300-400% rally from the bottom, and then so that's the major concern. So there is no doubt about the potential and the volume numbers, but from here on moving higher levels is the area of debate.
So Jagan is sounding a little cautious there. As always, thanks for joining us, Jagan, this evening on Profit with a check on what's the fundamental view on the market. Well, that wraps up this edition of D Street. Stay tuned, lots more coming up next.